The universe we're looking at now, which is ex-US small life sciences businesses that could have a chance of curing a cancer, or creating astonishing amounts of value based on what they're doing. If you have enough of a margin for error, you want to focus on the micro and on the company specifics over a long enough time period. And so I'm seldom explicitly thinking about what the impact of massive geopolitical things over which I've got no control might or might not be.
It's been a rollercoaster week, with recent news on tariffs triggering significant market reactions amid rising trade tensions. And to make sense of it all, I'm here with my co-host Yuri, and we're joined by Andrew Craig, founder of investment manager Plain English Finance, and author of Our Future is Biotech. Andrew, how are you?
I'm all right, thank you. Thank you very much for having me. It's always a real honour to do these things.
And to help us digest all today's topics, what tea have you gone for?
I am a coffee drinker, but I also spent quite a few months of my life in Japan, very fortunately, and so the teas that I do love are mugi chai and oolong.
Interesting.
Which, when you're in Japan, mugi chai is a barley tea, and it's no caffeine and really nice.
We were talking about this earlier, about those coffee runs you had to do as a junior working for UBS. 15 cups of coffee in the tray. And then everybody's trying to all the traders are giving you dead arms.
I've got to remember not to say things when I think I'm off the record, right? That's a true story. Yeah.
Do you miss those days?
I do, yeah.
All a bit too tame these days.
I think that's right. Anybody starting in financial services in London now probably isn't going to have quite the same experience that we had in the late 90s, that's for sure.
Well, we've got different challenges today with the tariffs, the geopolitical pressures, and I've actually gone for the green tea today to pay homage to your book. The Future is Biotech, and I had a quick skim through this earlier on, and one of the interesting things for me was how you're saying the biotech is going to affect everything, and how you're saying the transistor-centered computers will be substituted by biological computers, which sounds pretty scary for many of us. What do these trends mean for family office investors in biotech and related sectors?
My view is the last century, if you like, has been about physics and tech, and that's delivered, well, up until quite recently, north of 10% annualized returns for US equities for a century. And the next century, for a bunch of sort of fairly intractable, prosaic, structural reasons, is going to be about biology and biotech. And so that really is just because you create economic value from solving human problems and delivering human wants and needs. Most of the remaining challenges and problems we have as a species, all of which are huge opportunities, like curing cancer or dealing with dementia or Parkinson's or whatever else, but more perhaps even more excitingly, environmental degradation and revolutionizing agricultural productivity. These are all problems of biology. So and we're at a point now where the technology, the biotechnology, is it's developing exponentially. It's very exciting. Science fact is increasingly what science fiction was not that long ago. So basically, a gram of DNA can store about 215 million gig of data, something approaching the entire assembled data that human beings have ever created in history in something the size of a Ford Transit van, because DNA has got 4 bases instead of the 2 bases of the binary system. So, but what's even more exciting is if you can code something that whether or not it's living is kind of moot, it's biological, right? That if you can just code the DNA to store data, which you can then read back later, the really exciting thing about that is you wouldn't need any power. From a world of blade servers and hoovering up electricity all over the world and having to cool, racks of servers in great warehouses, you could move to a situation where all digital storage was just little sugar cube-sized things storing petabytes of information sitting on a shelf.
And Ali, you've been speaking to our old friends Sitzbank in Geneva about some of these innovations and how private markets and venture capital investments can be used to invest in the companies and the startups. One of your conclusions, interestingly enough, is that the alternatives managers are now looking at many small and medium-sized firms, particularly in the B2B space.
These businesses are often overlooked by larger players, and their valuations tend to be more attractive compared to US counterparts. I mean, Europe, with its large number of family-owned companies, presents significant growth opportunities, especially as these businesses continue to innovate. Is it true that in the type of biotech funds that you're looking at, there's also much more interest in these SMEs particularly outside the USA?
Due to a bunch of sort of historical structural reasons, the world's actually really bad at funding innovation in life sciences. And that's got far more to do with sort of structural challenges to the investment industry and the asset management industry than it is to do with the commercial potential in the science or the companies. And so to sort of unpack that, smaller companies in the UK doing biotech have confronted a complete desert in terms of funding. There's nothing out there. And a big part of the reason for that is structurally London's been so challenged. So, the London Stock Exchange had 3,250 companies a generation ago, and today it's got fewer than 1,700 in aggregate. And the reason for that is because UK pension assets used to be 53% in UK equities in 2000, and now they're 3% in UK equities. So the aggregate amount of capital available to equities is very small in the UK, and that's been hugely problematic. It's why businesses like Arm Holdings are now on the other side of the Atlantic, and lots of others. Biotech companies are definitionally smaller companies, the ones you're talking about, whether they're private or public, they're smaller companies. Smaller company asset managers are almost always generalists, and they don't have the specialist skills. They use conventional valuation metrics like PE ratios, return on capital employed, EV, EBITDA, whatever else, which you can't use for a loss-making, bleeding edge science-driven life sciences business. If you're in the States, you've got vast, many billions of dollars of capital, and you've got hundreds and hundreds of really exciting biotech companies sitting on your doorstep, and you maybe even have gone to the same Ivy League as the CEO, university as the CEO of that biotech. A British company is very, very much the poor relation. And that's genuinely been a valley of death and hugely challenging to British companies, to European companies. The valuation opportunity is really, really extreme. And there are companies valued at tiny little peppercorn valuations in the UK, Europe and Australia that if they were in the States would be much more richly valued. And I think smart family offices are beginning to look at that.
Beyond biotech, they're also looking at the environmental opportunities.
We carried out this excellent opinion piece from Surabhu Sharma, who runs the Sustainable Water and Waste Fund at J.O. Hambro Capital Management. He's been writing that the water and waste industries remain largely insulated from tariff pressures because much of the infrastructure underpinning these industries enjoys bipartisan political support due to the essential nature of the operations. Are you and your colleagues essentially now looking for these investments least affected by the Trump barrage of rhetoric and regulation?
The universe we're looking at now, which is ex-US small life sciences businesses that could have a chance of curing a cancer, creating astonishing amounts of value based on what they're doing. If you have enough of a margin for error, you want to focus on the micro and on the company specifics over a long enough time period. And so I'm seldom explicitly thinking about what the impact of massive geopolitical things over which I've got no control might or might not be. Tariffs, where the dollar's going, whatever else. I'm trying to find businesses that are so extraordinarily undervalued based on the commercial potential in the businesses that I don't really have to concern myself about that. And then the only other corollary I'd say to that is ultimately businesses that solve extraordinary human problems create a great deal of economic value.
Our colleague Elisa Travato has been working on our Global Asset Tracker survey and speaking to 50 chief investment officers of the leading private banks controlling about $25 trillion in assets. And Elisa very much has been finding that bonds are looking an increasingly attractive ballast against the equity-heavy portfolios with their volatility, and that fixed income is very much becoming a focal point. There's this perennial issue that's been confronting wealthy investors. When fixed income is coming back into fashion, bonds, private markets, alternatives, how do you decide which ones perform better in a portfolio?
A very, very simple rule of thumb that's worked for decades is 100 minus your age, whereby, if you're 30, you should be 70% aggressive and 30% defensive, and you're 70, you should be the opposite. And you should probably only change that allocation every 5 years or so. So that sorts your aggressive versus defensive. Then to your question about within defensive, ultimately, I think if you've got real estate exposure, primary residence, which is a huge exposure for most people, if not ultra high net worth people. If you then have potentially another or other real estate exposure through REITs or through whatever else, that's giving you a lot of defensive exposure and yield exposure. You probably, I would say, would still want to focus on rich country bond ETFs rather than govies of, challenged places with terrible balance sheets like most of the West developed world at the moment, as evidenced by what's going on with Trump and the States in particular.
As a result of Trump's unprecedented series of tariff announcements, and calculations that we can end up losing confidence in the dollar. And this could be the end of the so-called golden age for the greenback. An opinion that we featured from Benjamin Dubois of Edmund de Rothschild. Do you agree with this sentiment? Or are you in the camp, to paraphrase Mark Twain, the rumours of the death of the US dollar are vastly exaggerated?
Well, they've been vastly exaggerated for, as long as I've been in capital markets, right, which is coming up 30 years. The St. Louis Fed estimate is there's $102 trillion of outstanding US denominated debt, 36 trillion of which is government debt. And, each of the last 3 presidents has added more US dollar government debt to the extant stock of government debt than all previous presidents in the whole history of the United States. I believe I'm right in saying. If I'm honest, I kind of sidestep it because it's so, it goes back to my point earlier about if you're investing for long enough. I've been buying gold for 20 years and I've been undeterred by whatever's happened in the meantime because that's just a big structural call. I will be buying Biotech for the next 20 years. And I try to zoom out from all that noise because I believe that that's how you succeed with any kind of big picture thematic approach to investment.
The other thing we're going to have to do, Ali, is start bringing in tariffs with people drinking coffee instead of tea in the tea break.
I need to vet my guests, I guess. We need to vet the guests before
I promise
we bring
to
them
drink,
in.
if you can get me some mugi cha, Japanese barley tea next time,
We'll be
I'll
sure
have
to
that.
get that next time you're
Or
in.
yerba mate from Argentina, that's the other one.
Indeed. Andrew, thank you so much for joining us.
Thank you very much for having me.
Unfortunately, that's all we have time for. Thank you for tuning into this week's Tea Break. Make sure to catch our weekly episodes on the PWM website or the YouTube channel. And if you have any questions for our guests, visit the website for more information. See you next week.